Hello, everybody. Again, for those of you who just jumped on, first and foremost, thank you everybody for joining me. This was kind of exciting today. We have one of the largest webinars that we have been hosting. We've actually been doing a series of webinars, and I would encourage everybody to check our website here and there under our events page, because we've been doing numerous different trainings throughout the past few months, and that's being constantly updated, which gives you different ways that you can get information. All the webinars are free to everyone. We've been having a lot of our clients attend these, which is great as well as some non-clients as well. Most of the training has been revolving around QuickBooks so far, but this one again is on the new accounting standards that were just issued in August, which is a big change coming up, and I think just about every organization, nonprofit organization, is going to be impacted in one way or another. Actually, I think they're all going to be affected in one way. But we're going to go through in detail a lot of the major changes today. But before we do that, just a couple quick housekeeping things. First, for those of you who haven't, there is a handout that you can download right off of the GoToWebinar. And that handout, we're going to kind of walk through a couple different times. I'm going to reference some page numbers as we're going through this for some examples that were just much easier to go over the examples in the actual standard itself versus put it in the PowerPoint, just because of the length of them. But also it's a great reference point to the standard in case you need to go back. So like I said, if you want to take a moment and download that. Second, if you have questions throughout this process, there is a way to ask questions. Due to the volume of people that are actually attending this, we're not going to have it that you can do it via your audio, via the phone, but you can ask questions right on the GoToWebinar, and I would just encourage people to ask these questions as they go about, as we go through it, and I will take time here and there to stop with the actual presentation and we'll answer questions as they come about. So feel free to ask questions, because I'm sure there will be some as we go throughout this process. Couple other things. One, I guess at the end of this, if you would like, we will be sending out the PDF, a PDF version of this PowerPoint presentation for you also to be able to reference in the future. In addition, if you want to go back, or if you want to share these with your colleagues or other organizations that you work with, here in the next few weeks, this webinar will actually be put up on our YouTube channel. That you can actually go to our YouTube channel and actually rewatch this and go back and listen to anything that you might have missed or want to hear a second time. So that's the other thing. So check out our future webinars page, like I mentioned before as well, if you're interested in getting some other type of training. And also feel free to shoot us an email and let us know of other things that you would like training on. We'd be happy to add it to our series that we're doing here. So let's jump in to the actual new standards and what we're doing. So what we're going to go through today. So first and foremost, this is a change in standards that we knew was coming for a while. The first exposure draft for this was actually issued back in April 2015. And at that point, an exposure draft, for those of you who don't know, is when the FASB comes out and issues basically a draft statement and asks for comments on them so that CPAs and those in the public can respond to them and give their opinion. After that, the final version was issued in August 18th of this year. So it was, like I said, it was issued on August 18th, effective. And so the effective date, the key thing with this is the effective date for these is fiscal years beginning after 12/15/17, so December 15, 2017. Therefore, it's those who have year ends of 12/31/18 or June 30th, 19 if you're a fiscal year end. So it's for the fiscal year beginning after December 15th, 2017. Now, while that may seem like that's several years in the future, we're going to go through different things, and you're going to find out why it's important that you understand these standards now versus the future. Because in the future, you're going to need to make changes now that will affect how you will be able to implement these. If you don't take the time now to figure out how you're going to go about implementing the changes, When those fiscal years end, you're going to have issues, especially those of you who are doing comparative statements, because if you're doing comparative statements in June, if you're a June 30th 19 year end, you're also going to need to implement some of these effectively as of June 30th 18. And a lot of these things we're going to go through. You're going to want to take time to go through things with your board because there's going to be several policy changes that you're going to need to make. Phase 2, there is a phase 2 in process still. Originally, the thought was we were going to have one big giant standard, of which now we only have, they decided to split this up into 2 different phases. Phase 1, I think, is going to impact more organizations than phase 2. Phase 2, the couple of things that they're still in process is deciding whether to require operating measures within the footnotes of the financial statements. That would be actually being able to describe what different operating measures that you have. Second thing is there's going to be more changes to the statement of cash flows, of which the statement of cash flows right now, there's going to be some changes we're going to go through in phase 1. I think, to be honest with you, most will not affect most organizations in the statement of cash flows, but there will be more coming in phase 2. And then phase 2 also has segment reporting for healthcare entities. So if you're not a healthcare entity, this really won't apply to you. Phase 2. So that's what I mean by a lot of these. I think these are more fine-tuning things in phase 2, whereas phase 1 is definitely much more of a broad stroke across all nonprofits and how they're going to operate. So let's move on. So the question everybody always asks me and all my clients, why in the world are we changing the standards? Feels like every 10, 15 years we go back and we change everything all over again. I always joke with people the reason is because they can, but the reality is they are going to change. As the more things change, the more they stay the same. Why is FASB changing the standards? The main reason that they gave that they're changing these standards is the complexities about the use of currently required 3 classes of net assets that focus on the absence or presence of donor-imposed restrictions and whether those restrictions are temporary or permanent. So the main thing with that is that they're concerned with that there's complexity between unrestricted, temporarily restricted, and permanently restricted net assets, and there seems to still be confusion, even though we've had these for a long time now, that they felt that they were still complex and there was still confusion about that. The second reason they gave was that there's deficiencies in the transparency and utility of information useful in assessing the entity's liquidity caused by potential misunderstandings and confusion about the term unrestricted net assets and how restrictions or limits imposed by donors, grantors, laws, contracts, and governing boards affect an entity's liquidity, classes of net assets, and financial statement performance. And basically what they meant by that is that they are confused, they were worried that people still are not understanding how liquid an organization is relative to based on their financial statements. Third, the third reason is that there's inconsistencies in the type of information provided about the expenses for the period. For example, what they're giving, the main example is some of you are using a statement of functional expenses and many of you are not. The statement of functional expenses has not historically been a required statement, except for those that are healthcare organizations were required to. But the rest of you were not. A lot of you are because you were already doing the work when it came to doing your Form 990 that you were breaking out between management in general, your program, and your fundraising. But at the same time, many of you were not because you were smaller organizations when it came to actually your financial reporting. You were not doing that. And so there was inconsistency from financial statements to financial statements, depending on the organization. As you're going to see, they corrected this problem. The fourth is the impediment of preparing the indirect method reconciliation of if a not-for-profit uses the direct method of cash flows. This to me is the most, I guess I shouldn't say most. This is the one that I think affects the least amount of our nonprofits. Our organization works with well over 50 nonprofits a year, and I don't know that any of them are using the direct method of cash flow. So in the end, if you're using the indirect method, not a lot's going to change. This is only a change if you're using the direct method of cash flows, which I know most of our organizations were not. So that's why, I guess that's why that FASB gave the reason. You know, as I put here, there's nothing permanent except change, because in accounting, everything is always changing. It is rarely, there's always going to be people who think that we can do things better. In the end, when I review these, I do think that these actually do make some great improvements to the actual accounting structure, and do make things a little bit more simple in some areas. At the same time, I think that there's a lot of these changes that I think are going to be difficult for some organizations to implement that have not been doing these things already. And so that's where it really comes down to, you're really going to have to think ahead as to what it is that you're going to need to do to be prepared for these. Because if you don't do things ahead of time, and I want to encourage everybody who goes through this and starts to think about their own organization, that they actually start thinking about, how can I implement this now? Because a lot of these things are going to be how you're doing things. If you're using software, for instance, such as QuickBooks, you may have to change how you're doing some things in order to be able to report to your auditors, to your reviewers, you know, to your accountants, how they're going to be able to extract the information that they're going to need for their financial statements that they're preparing for you. All right, on to the next. So who is affected by these changes? Well, the obvious one is all nonprofit organizations are going to be affected. But at the same time, there's going to be numerous other people who are going to be affected by these changes. I mean, and the people that I listed here, the public, the governmental entities, and foundations, the main reason how they're going to affect is their financial statements are going to change. And how they read them then is going to change. The goal of this whole project was to make financial statements a little bit more uniform from organization to organization, which should actually help these users of financial statements read and understand a nonprofit set of financial statements that they could not previously. So hopefully you'll agree with this by the end of the end. So we're going to go through the major changes step by step, and I think this first step is going to take the majority, I mean, good chunk of our time here today. We do have about 2 hours set aside for this today. I'm not sure it's going to take the whole 2 hours, but I wanted to make sure too that we have plenty of time for people to ask questions. So again, if you have questions as we go through this, let me know. But we're going to start with net asset classification, which I think is the largest piece of the change of what's going on here. And when you go through this, I think some people are going to say, well, that doesn't seem so difficult, because many of you, because of the way you've been handling your net assets, this is going to be a fairly simple change. Many other of you are going to find that I think that it's actually a much more complicated change, just because of the way you're doing your bookkeeping. It may be more difficult to get this information in the way that it has to be presented. So let's first go through here, and I think we'll do a quick review of how the net assets are done right now, because it's important that everybody understands how the net asset classification works today, because it's kind of the preliminary step moving to the next step they've went to. So historically, and is the rule still today, so your financial statement still for the next few years, you have 3 types of net assets. The first is unrestricted net assets, which consist of unrestricted amounts that are available for use in carrying out the mission of the organization. The way I like to think about unrestricted net assets are, if it's not a temporarily restricted or permanently restricted, it must be unrestricted. It has to be. So temporarily restricted net assets consist of those amounts that are donor restricted for a specific purpose. When a donor restriction expires, either by the passage of a stipulated time of restriction or by the accomplishment of a specific purpose restriction, temporarily restricted net assets are reclassified to unrestricted net assets and reported in the statement of activities as net assets released from restrictions. What the key words in this, and I think where most organizations get tripped up in this classification, is the key word is donor. Consists of the amounts that are donor restricted. It's not board restrictions. It's not a contract for service. It's nothing like that. It's when a donor restriction. So that what we're talking about here is contributions. If the revenue that's coming in is not a contribution, the result is never going to be, let me take this back, make sure I say this correctly. If what you're receiving as revenue is not a contribution, it is going to be an unrestricted net asset. If it is a donor and it is a contribution, then the question becomes, is there a restriction on that money? If there is, it's going to be either temporarily or permanently restricted, and if there is none, it's still going to be unrestricted. So I guess that's the key thing. Permanently restricted net assets result from contributions from donors who place restrictions on the use of the donated funds, mandating that the original principal remain invested in perpetuity. The best example of these is endowments. Some of you may have cases where someone says someone passes away and says, I'm going to leave you $1 million. I don't want you to touch the $1 million, but you can use the interest for XYZ purpose. And so the permanently restricted part's that $1 million. There will always be permanently restricted assets of $1 million because you can't touch the principal. You're just allowed to use the earnings. So those are the three net asset classes that we started with before the before the change. So after this, we now have just two. We're going down to two net asset classes. The first, our unrestricted net assets, is the easy part. They're now going to be called net assets without donor restrictions. The other two, temporarily and permanently restricted net assets, are now going to be net assets with donor restrictions. So in the end, we took three classes, boiled them down into two, and the key thing is that I like about this is they use the word donor within the actual terminology. Again, going back to most organizations that I've seen have issues, it's because they're calling things like governmental contracts donations, which they're not, and they're saying they're restricted because they can only use the governmental contract to perform certain types of services. Therefore, it must be restricted, but they're not donations, and that's where it starts in the analysis. So I like that they put that in the actual terminology. But in the end, so your financial statements now will only have two different types of net assets, one with donor restrictions and ones without. And that's all there's going to be, which actually makes this seem a lot more simple. At the same time, it seems also like we're getting rid of a lot of detail that we used to have in the financial statements, because some of this, you think about it, all that $1 million we talked about, that endowment they gave, it's now going to be sitting in the net assets with donor restrictions, along with the $20,000 that you had that was a temporary restriction because it was used to fund a program for next year. So because of that, there's going to be some other changes that are implemented along with this. So they have some new definitions for these, and this is really where I kind of like what they've done. The first is the net assets with donor restrictions. It's the part of net assets of a non-for-profit entity that is subject to donor-imposed restrictions. And then they added this in, which this is what I really prefer. Donors include other types of contributors, including makers of certain grants. The word grant previously was not in the definition. Because you receive a grant is not necessarily by default a contribution. It's also not by default not a contribution. It normally depends on there's numerous different factors as to whether a grant is actually a contribution or it's not a contribution. And typically it comes how much strings are being attached to it and how much the donor or the person giving the grant has control over it. But what I like this is that a lot of times in the past people interpreted if it's a grant, it's not a donation. And right within this, the definition of it now, they said that it's including makers of certain grants to let people know. For instance, if you're receiving a foundational grant, the chances are it's a contribution. And it should be in those net assets with donor restrictions. The new definition of net assets without donor restriction is the part of net assets of a not-for-profit entity that is not subject to donor imposed restrictions. Donors include, again, other types of contributors, including makers of certain grants. They put that in there for emphasis. So those are the two definitions that we're working with, which actually really simplifies it. The question is there a restriction? First, I guess the first question is this a contribution? Is this from a donor? And if so, is it with or without restriction? And that's the analysis now that we would have to do, which is much more simplified than what it used to be. So then the question becomes, how do we present this in the financial statements? So in your statement of net assets or the balance sheet, this is the minimum presentation that is now required by FASB. It's just net assets without donor restrictions, in this case $51,236, and the net assets with donor restrictions 27,258, totaling up to the 78,494. This is the minimum presentation that you're allowed to have. The other way that you can have this alternate disaggregation that they talked about in the standard, this is the other way that you now are allowed to present it. And for those organizations that want to give more detail, this is a great way to be able to do it and show people those with and without. You still have to show the total of those two categories, but you can actually put amounts in here. And I think in the end, we're going to get to a couple other changes in the standards. And I think more and more people, while they've never wanted to do something like this historically, now may want to think about presenting things this way. So you see the first part of it without donor restrictions, there's an undesignated part, and then the second part's a designated by the board. And we're going to get, because there's a change in the standards when it comes to board designated assets. And we're going to talk about that. So that's one way we're actually going to show that this is how you can actually present it. If there's net assets that are restricted by the board itself. The second part of this is with donor restrictions, of which then you can put, for instance, some of it's time restricted for periods after, a certain year. Other parts are purpose restricted, and the other parts are perpetual in nature. So basically, you're allowed to say, okay, well, with donor restrictions, part of it's based on time, part of it's based on restriction, part of it's based upon the fact that the principal can't be touched, which all this is very useful to users of your financial statements, because they're going to see that this, the numbers that, for instance, used to be in the temporary restricted column, they're going to know whether it's time restricted, purpose restricted, etc. With that. So this is just an alternative method of how you can actually see this. The next part of this is the disclosure requirements within the donors, and this is where things get a little bit more complicated compared to how they used to. So this is the example footnote that FASB has in the standard saying how they would like to see donor restrictions in the footnotes, because in the footnotes now we need to break it down even further. And so, for instance, these numbers will not tie to my previous example. This is literally the example straight out of the actual standard itself. So you're going to see that it has in detail here, subject to expenditure for a specified purpose. And then you have program A activities, program B activities, broken down essentially by your programs, program by program, these restrictions. You're also going to see that there's a restriction for building and equipment, annuity trust agreements and research. There's a section for this, subject for the passage of time. There's going to be others that are subject to non-for-profit spending and policy appropriation, and those are your investments into perpetuity. And you go through here and you see how detailed this actually is. So historically, while you were tracking your temporarily restricted, many organizations were tracking these net assets as a whole. Here, it's going to be much more detailed, and it's in the financial statements themselves, in the footnotes, there's going to be a ton more detail that people who are reading your financial statements are going to have as to what makes up those restrictions and how they can be spent. This is important because in the end, like I said originally from back at the beginning, one of the complaints is that there wasn't a lot of transparency as to what was in, the temporary restricted, and people reading it weren't sure, is this something for next year? What program is it that it's actually being used for? And donors like to know that information, and when they would get your audit, they really would know the specifics of what programs already had restricted money and what programs did not. They just knew you had a bunch of restricted money. So this is a lot more detailed, and you're going to want to make sure that your bookkeeping can actually have the detail of what programs have net assets and how you're spending off of each one of these programs down to the program level. And again, many of you using QuickBooks using things like the class functionality to do this. That's great, and it's probably, between that and tracking those net asset classes, it's going to be fine. but many of you who are not, or maybe have lumped up programs together, it's going to be a little bit more difficult. So those of you who have, a large number of donations that are restricted, there's going to be some more bookkeeping work on your side to go through this. So that's what the new presentation is going to look like within the footnotes themselves. The other part of the net assets that is going to be new is this board designated net assets. Now, I've worked with numerous organizations who actually have board designated net assets, but they didn't really show up anywhere. The board has, said, we're going to put aside of our unrestricted balance, we want to designate $10,000 to a rainy day fund, or we want to earmark $20,000 of our net assets to a new program that we're starting. Now, when you had that, the board was keeping track of that, but many times on your financial statements, it wasn't anywhere it would be seen, these designated net assets. And because of that, a user who's looking at your financial statements would not know what those net assets, that there were these board designations, that the board had already set aside a certain amount of money. And the theory always behind it is because the board can change its mind anytime it wants. There is no requirement, but once a board says we're going to use this for this, that they can't change their mind. Well, now there's a new required disclosure of the nature and amount of a board designated net asset. So now, if you have these, you have to disclose it. So let's go back and let's look real quickly at the definition of what now the new definition is for a board designated net asset. The net assets are subject to imposed limits by action of the governing board. Board designated net assets may be earmarked for future programs, investment, contingencies, purchase or construction of fixed assets, or other uses. Some governing boards may delegate designation decisions to internal management. We'll go back to that sentence in a minute. Such designations are considered to be included in board designated assets. So when I read this definition, a couple different things. One, it pretty much anything that they earmark money for is a board designated asset when it comes to the board designation. But the second part of this, which I think is the most interesting, is some governing boards may delegate the designation decisions to internal management. So how I interpret that is the board can say, you who is the executive director, you can actually start designating net assets, and we're going to have you be in charge of it now instead of the board. This is not a board, we're pushing it down to internal management. This is important because many times too, the executive director and the finance director might be the ones who are actually doing the budgeting and those things. It's important for them to know what's being designated. The key takeaway point in all this is there's a need for nonprofits to have board policies and practices regarding board designations, even if historically there haven't been any board designated net assets. Because the first question that's going to come up is, has this board designated net asset function, has it been delegated to, for instance, the executive director? Because the executive director might be earmarking money, but the question is going to come up when these standards change. Did the board actually designate that responsibility to the executive director, and can they actually designate those assets? So the first thing you're going to have to go to your board is and say, do we want this to be a board function? Do we want it to be an internal management function? Second, you're going to need to have, for instance, in your minutes, if you are designating net assets, and then you're going to need to keep track if they have designated them when they're being spent, just like you're doing with your temporarily restricted net assets and your permanently restricted net assets. Now, I can see a lot of you out there probably are worried because we're putting a lot of boards love to designate things all the time. And so the key thing is now the question is going to be, have you have an actual formal policy? Because you're going to need to discuss this with your boards and make sure that they understand that if they do designate it, it's going to increase the amount of bookkeeping that's going to take place on your side. And second, it's going to show up in the financial statements that they've actually designated these net assets for a specific purpose. So that's how board designated net assets are going to change. And a takeaway point, like I said, need to have the discussions with the boards, because while it may seem like it's a few years away. I would say it's a great thing to get in the habit of starting to do now, and also just because a lot of board actions take a while. Some of your boards might be only meeting, quarterly. This may take a while to actually for them to make decisions based upon how they want to proceed with this. All right. Once the question then is, how do you disclose these requirements, the board designated net assets? You can do it two different ways. One, you can do it a tabular format in the face of the financial statements, and I'll go back a couple slides, which is exactly what we mean by this. Without your donor restrictions designated by the board in that way, that it's separated out. And then the other way is, if you don't want to do that, that's fine. You don't have to do the tabular. You can have it as a text disclosure in the notes of the financial statements. What I'm going to recommend to our clients, unless FASB comes out and says other ways, I actually think we're probably going to do both. Meaning, I think it's great to have it as in the tabular format on the face of the financial statements, but at the same time having a disclosure in the notes so that we can then further describe what makes up those is going to be a much more effective way of communicating these things to the public and those who are reading your financial statements. And I think that's going to become the best practice, is going to be to have it at both places. All right. So far, we don't have any questions. Like I said, feel free to type away any questions that you may have as we're kind of going through this, and I'll be happy to answer them. A couple other minor changes. I don't think that, at least in my client base, we don't have a ton of these, but I'm going to bring them up because there are a few other little nuances within the changes concerning net assets. The first is involving changes or donations of or contributions restricted for the purchase of property and equipment. Historically, a lot of times organizations, what they were doing is if someone donated a fixed asset and it was to be used for a specific purpose, they were keeping track of that in their temporary restricted net assets and were effectively releasing the restriction over the life of the fixed asset, effectively when the depreciation took place. This changed that and said that you cannot imply a time restriction on the donation. And the key thing is once the fixed asset is placed in service, it's the place in service approach, it becomes unrestricted. The other part of this is if you have underwater endowments, there's a new definition when it comes to underwater endowments. Underwater, and the definition is a donor-restricted endowment fund for which the fair value of the fund at the reporting date is less than either the original gift amount or the amount required to be maintained by the donor or by the law that extends donor restrictions. Where this happens is if donors give an endowment and it's invested in something, for instance, as a mutual fund, and the mutual fund value goes down, and so the fair market value of the fund, the amount of money that's there is less than what was originally contributed. The answer to this is you report the entire balance now in the endowment fund with donor restrictions class of net assets. So there's some little changes within the underwater endowments. All right. So that is net assets. Those are the things that have changed. Like I said, the majority of all organizations, this will impact them in one way or the other. Even if you're not an organization that has lots of contributions, even the board restrictions, I think, affect, because a lot of times boards do like to designate net assets, even if they don't have temporary restricted net assets. All right, let's move on to a couple of new things. There's some new required disclosures in these statements. And the new required disclosures, this is one of the ones that I think a lot of organizations are going to not like. So one of the new required disclosures is that qualitative information on how a nonprofit manages its liquid resources available to meet cash needs for general expenditures with 1 year of the balance sheet have to be disclosed. Qualitative information that communicates the availability of financial assets at the balance sheet date to meet cash needs for general expenditures within 1 year of the balance sheet has to be also disclosed. And so basically, what the disclosure requirement is that you are going to be required to have a footnote that explains how you're going to manage your expenditures for the next year. So I want everybody to turn, because I think if you look at the examples that the FASB gives, it's a little bit easier to understand what it is that they're looking for. So if you turn to page 90 in the actual standard, I'll give everybody a couple seconds to get there. You go to page 90, you're going to see that there's two different ways that you can actually disclose this. And the key thing is going to be which way you're going to do case A or case B is going to be if you're using a classified balance sheet or if you're not using a classified balance sheet. Most of you are probably using a classified balance sheet, so case B is what we're probably going to be looking at. But if we look at case A on page 91, actually, you're going to see here's the statement of financial position, but then the actual illustration of the footnote is here. The not-for-profit has $395,000 of financial assets available within 1 year of the balance sheet date to meet cash needs for general expenditures consisting of cash of $75,000, contributions receivable of $20,000, short-term investments of $300,000. None of the financial assets are subject to donor or other contractual restrictions that make them unavailable for general expenditure within 1 year of the balance sheet date. The contributions receivable are expected to imply time restrictions but are expected to be collected within 1 year. Not-for-profit organization has a goal to maintain financial assets which consist of cash and short-term investments on hand to meet 60 days of normal operating expenses, which are on average approximately $275,000. Not-for-profit A has a policy to structure its financial assets to be available as its general expenditures, liabilities, and other obligations come due. In addition, as part of its liquidity management, Not-for-profit A invests cash in excess of daily requirements in various short-term investments, including certificates of deposits and short-term treasury instruments. As a more fully described note in X, Not-for-profit A also has committed lines of credits in the amount of $20,000, which it could draw upon in the event of an unanticipated liquidity need. Now, I'm sure a lot of you out there are reading that and going, wow, that's a lot of information, of which many of you, hopefully not many of you, haven't even thought that far ahead when it comes to how in the world you're going to meet your obligations. So this footnote is going to be a footnote too that your auditors, your reviewers, your accountants that are doing your taxes, well, not the tax returns, but when anybody who's reporting on financials, so your reviewers and your auditors, are going to come to you and they're going to have to actually ask you to prepare this footnote, because at the end of the day, they're not going to know. Because this is all how management has looked at their cash needs for the next year and then put it into how, put it in the financial statements, how they're going to meet these needs, which this is kind of, I think, going beyond an extra step that a normal set of financial statements would have. So case B, we'll move on to case B and how this is a little bit different. If you're using a classified balance sheet, so you're showing your current assets, you're showing your current liabilities, non-current and all that, you can see note T, how it's a little bit different, another way of presenting it, where they're saying not-for-profit A's financial assets within 1 year of the balance sheet date, and they're actually labeling out these are our current assets. And then they go on to, again, describe essentially the same thing about how, the detail of how they're going to meet their needs. This is something that I feel like you need to make your board aware of and really start thinking about now, how you're going to write this footnote. Because at the end of the day, some organizations, this is going to be easy because they have plenty of available funds. This is going to be something very simple. We have plenty of cash. We keep, maintain 60 days worth of cash at all times, et cetera, et cetera. The issue with this is going to be is if you're an organization that's not doing that well financially. And if you're not doing that well, and I say here's the impact of the change of this one, new footnotes disclosure. The first part is, you're going to have to write a footnote. But the second part of it is the nonprofits that are strained are going to be required to describe how in the world they plan to correct the liquidity issues. And why I think this is important is if you think about people who are reading your financial statements, potential donors, grantors, etc., they're going to pick up that this new footnote exists. And they're going to go to it because it's almost now just as important as your balance sheet itself. Because the balance sheet's going to say, well, here's how much cash I have, receivables, but this footnote's just, directly talks to how you're going to meet your liquidity. And if you're not sure how you're going to meet your liquidity, for your obligations in this upcoming year, this footnote is going to be difficult to write, and it's going to become obvious that you can't. Which this will also feed right into the upcoming, which we're not going to go over today, but the new going concern standard that came out last year that's implemented, I believe, next year. That this is going to kind of go hand in hand with that. So the key thing is think about how this footnote disclosure, how you would actually write this, and how you're going to communicate to your auditors how it is that you think as management, as a board, how you have liquidity within your organization, how you're going to meet your current obligations. And second, if you're going to have issues, it's going to force people to start thinking, well, how are we going to meet them? Because in the end, I'm going to have to tell my auditor how I'm planning on fixing this liquidity problem for the upcoming year, because again, it's still going to need to be in the footnotes on how you're doing that. So this is one of the things that I think was in there, that while it doesn't seem as big as changing net assets, this is actually quite an important new footnote that people are going to have to think about. That's going to impact a lot of people. And like I said, grantors, donors are going to pick up on this and read it. And for some organizations, it's going to be great. In other organizations, it's not going to be great that they have to put this in there. All right. All right. Next big change. Functional expenses. All right. Everybody hopefully is hanging in there. All right. Functional expense changes. So many of you who are attending, I know, have a statement of functional expenses. For those of you that do, this isn't going to be that difficult. But there's a lot of organizations, including several of the ones that I know are on here today as well, who do not present their financial statements with a statement of functional expenses. For those of you, this is going to be much, much more difficult to do, and you're going to, again, I would encourage people to start thinking about this long before things need to be implemented. So the first new requirement is that you must present an analysis of expenses by function and nature in one location in the financial statements. So what they mean by that is the functional expenses need to be all in one location in the financial statements, but they don't tell you where it has to be. Now, many of you in the past have always just used the statement of functional expenses, and if you've been doing that, you can just continue to do that. Second part of this is that it can be also part of your financial statements. It can be part of your basic financial statements that you can actually do this right within the actual financial statements themselves. Third, and the way I'm probably going to lean towards telling my clients I would prefer them not to do it, it could be part of your footnotes. And I can't imagine those of you who do have statement of functional expenses saying, yeah, that's a great idea. Let's take the statement, let's put it in all the verbiage in the functional, in the footnotes. But that is actually a way that you can be allowed. The key thing in this is, the thing that is new is that there now must be a footnote on top of it to describe how your organization is allocating these costs. Now, for those of you who have been allocating them, you already have probably some sort of functional expense methodology. But because we're going to put this in the footnotes, one of the things that I don't think you can do anymore, which some organizations do, is say, well, we kind of use a general 10% of everything goes into management general, 10% into fundraising, 80% program. You're going to have to get a little bit more detailed. And the thing that's going to become a requirement, which probably you were doing anyways, hopefully you were doing anyways, is that when your auditor comes out, they're going to say, okay, how do you do this? And you're going to need to have it in writing. This is how we go through and do our functional expenses, because the footnotes of your financial statements are the policies of your organization. And if you don't, it's going to need to be in writing. So you're going to need to have in detail how you're actually allocating things. For instance, you're going to say, we allocate rent expense based upon square footage of the programs versus the admin staff. And we allocate internet usage based upon, the amount of staff that we have that are program versus non-program staff. Those types of things, you're going to have a policy of how it's written, and then from there, you're going to actually be able to prove that that's actually how you're allocating those expenses. So I think the two part of this is, for those of you who have not been doing functional expenses, you're going to have a lot of work on your hands, because you're going to have to allocate these expenses based upon some sort of methodology that you're going to need to create. For those of you who have been doing functional expenses, the key thing is going to be, you need to make sure that it's in writing and that you're doing it consistently, because now you have a requirement that it's actually there, and there's going to be a footnote describing exactly how your organization allocates those costs within that. So I think those are the couple big things in describing in the change in the functional expenses. And here's an example, and this again comes from the AICPA, an example of what they mean by this, what the note will look like. It says the financial statements report certain categories of expenses that are attributable to one or more program or supporting services of the organization. Those expenses include depreciation, the executive director's office, communications department, and information technology department. Depreciation is allocated based on a square footage basis. The executive director's office is allocated based on a time and cost study of where efforts are made. Certain costs of the communications department are allocated based upon the benefit received. And the information technology department is allocated based on a cost study of specific technology utilized. That's the kind of detail that they're expecting when it comes to your functional expenses. So I just want to encourage everybody, again, this is not something you want to do overnight. Think about how you're doing your functional expenses. And for those of you who are doing functional, I guess I should say this, it should be for everybody. Everybody, this is the one step that I think you can really start thinking about now, and I would encourage you to implement immediately. Just because in the current financial statements, the year that you're in, you don't have to do this footnote. I would encourage you to start thinking about it and getting used to doing it. Because in the end, in a couple years from now, when you actually have to start doing it, you don't want it to be the first year that you've ever done it. There's no reason that you can't start thinking about and doing this now, figuring out within your accounting software, how do I keep track of these functional expenses, and how are we going to write these policies down in a method that everybody can follow, and that the auditors can follow when they come out to look at our work. All right. All right, so we can bend back to, here's the issues that are out there. Many organizations do not have a formal method of allocating expenses. That's the biggest problem I think that most people are going to have, that they are allocating it, but it's not a formal method of allocating. So what I was saying, the key points I want to take away is that A, you need to develop a plan. B, this needs to be discussed with the board of directors and the finance committee to make sure they understand how you are doing this, because in the end, if you don't have a method, this is actually a policy and procedure that the board probably should get involved with, that they understand how you're doing it. The third, C, is to implement the plan prior to new standards taking place, which is, again, what I was saying earlier. The other thing that was in the standard that I really appreciated was this, because there was always a question when it came to management and general activities. For instance, the executive director, do we put them in management in general because they are management, what they should be? And they clarified this within this standard, which I really like. The activities that represent direct conduct, or the key part, direct supervision of program activities, require allocation from management and general activities. How I interpret that is, if you're the executive director and you are overseeing programs, just because you're not doing direct conduct of the program, you still should be allocating some of your time to program activities. Same with the CFO. CFO, that just does accounting, But part of that is if any of this is direct supervision of program activities, it even went down to describe grant accounting. If you're the accountant and you're doing accounting for a grant that is directly funding a program activity, part of your time should be allocated to program and not be in management in general. I think for a lot of organizations, this is going to be a way that you can move part of your expenses out of management in general and in the program. And this is, again, going back to as many of you know, I know with my clients, we talk about this all the time. This is important from the standpoint that you're going to be able to move, the more you program expenses you have, the better for your donors and your grantors. They love to see, they always ask the question of every dollar that I give you, how much is actually going to go to the program? And here, what they're basically saying is that we know a lot of organizations are putting way too much in general and admin because they think because you're management, you can't allocate it over into the program. Here's what we're saying is you should be. The key thing is going to be going back to the point 1 on this slide. You're going to need to have a formal method of how you allocate those expenses. For a lot of people with like the executive director, it's going to be how much time are you spending, and you may have to do a time study. You may decide to implement timesheets, those types of things, to figure out how much time are you spending doing your different activities so that we know how much we should be allocating into the program versus the actual G&A. All right? So that's, again, does anybody have any questions? I still have no questions. Hopefully the question is working on the GoToMeeting, but I don't have any questions so far. I know we've covered a lot of information so far. But all right, when we get to the end, we can answer anything that anybody has. If you just want to type your question in, that would be great. Other notable changes in this. There are a couple of minor things that I'm not going to get into a lot of detail because I don't know that it's going to affect near as many people. But if you have questions about it later, we certainly can answer it. The key thing is a couple of different things. The investment return, the change now is that you report investment returns net of external and direct internal investment expenses and no longer require disclosure of those netting of the expenses. The key thing with this is that you can actually use some direct internal expenses. So if you're incurring direct internal investment expenses, you're going to net it against the investment return. For a few of our clients, this would apply to them. This does not apply to programmatic investing, meaning if you're an organization that makes loan as part of their mission, then you would not net the expenses against the investment return. This is only for people who are investing money outside of their program because they have excess cash that they want to invest. Second thing that's the other minor change I would say, and here's the cash flow changes. I'm saying it's minor. There is a fair amount of changes, but it's just because most of my clients are using it. I think most clients are using the indirect method. You still can use the direct or indirect. The key thing is if you use the direct method, you're no longer required to show the indirect reconciliation, which is actually one of the reasons that a lot of people don't use the direct method because the indirect reconciliation was the more complicated part. You're no longer required to do that. I don't know how this is actually going to change. I mean, we'll see. But I still have a feeling that most organizations are still going to use the indirect method. So those are the major parts of the change in the standards. So I wanted to kind of go through a little bit on how the application of the transition period is going to go for all these changes. So the key thing is first, all provisions become effective in the year of the adoption. Why this is important is that you can actually early implement this, and we're going to get to that in a minute, but the key thing is all provisions become effective in the year of adoption. So June 30th, 2019 for most of you who are June 30th year ends. For comparative years, now this is important, and this is why I mean it's coming up faster than you think. For those of you who have comparative financial statements, you will apply all provisions to the prior year financial statements except the analysis of expenses by nature and function and the liquidity analysis. Therefore, the key thing is when it comes to your net assets that we talked about and several of the other standards, you're going to have to apply them to your June 30th, 2018 numbers, not just 19. So if you do comparative financial statements, the effective date, while it's still 19, that's the first year it's going to show up in your audit, the comparative numbers are going to have the same standards in it. So that's a key thing. So it comes a year quicker than you're thinking. We're already in fiscal 17. The next year, 18, if you're going to do comparatives, is going to affect that. When you do that, you're going to disclose the nature of any reclassifications and their effects. So when we do your 2018 financial statements, they'll look the old way. In 2019, there may be some changes and reclassifications that take place due to these standard changes. Then you're going to have a footnote that says the prior financial statements changed because of these standard changes and how they did. The most obvious of that is that your net asset classes, when you report in June 30th, 2018, you're going to have 3 types of net assets. In June 30th, 2019, you're only going to have 2 with new names. So that's where that's going to change. Last but not least, early adoption is permitted. You can implement these standards now if you want to. You could say, I want to do it June 30th, 2018. I don't want to wait that long. That is permitted. But a couple of different things. If you early adopt, all provisions must be adopted. What the key thing with that is you can't cherry pick which ones you want to do. If you implement the standards, the new standards, you're implementing all of them except for these 2. The first is the analysis of expenses by nature and function. You do not have to do that, and the disclosure around liquidity. But everything else that we talked about, you have to implement them all. So it's not if, you know, I want to put my functional expenses in there, even though you don't have to, and I want to disclose my board restricted net assets in the way that the new is. The key thing is it's an all or nothing proposition. You're either going to do all of them or none of them. You're just going to keep on going like you're doing it now. So those are the key things when it comes to if you decide to early adopt. Is there any benefit in early adopting? It's going to depend on the client and depend on the user. Many people might read this and say, yeah, I'd love to early adopt because I think my grantors are really going to love seeing this new information in there. That's great. Other people are going to say, I want as long as possible to get ready for this, and I don't want to implement it early at all. And in fairness, most organizations do not apply new standards until the year it's actually required. Typically, you need a period of time to make sure that your bookkeeping is up to date. For instance, I probably would not recommend anybody in their June 30th, 2017 or calendar year December 31st, 2016 people to do this because you're already into this year and you're already operating, and you want to make sure you have all these things done for the beginning of a year. For the next year, it's a question of, can we get things in a row that we want to do that? The other reason too is that typically whenever there's new standards that's given that are new standards that are put out, there's a period of time that there's going to be all kinds of explanations and those types of things of how people want to see it. And the earlier you adopt, you always run the risk that you're going to do things that later they're going to say, well, you probably shouldn't have done it that way. We actually meant this. So that's another reason why a lot of times people will push things off to the actual date that they're required to adopt those standards. And that's really what I have today. I know we got done a lot quicker, but I have not had any questions, which I was anticipating a lot more than we actually had today. What I was going to say is, you see on the screen, you have my contact information. You can call us, you can email us. I really would encourage people to get us on your Twitter and get us on your Facebook. We do put a lot of stuff out via Twitter and Facebook when it comes to different things that the firm is doing, different updates, different articles and stuff I read that I think apply to organizations. It's a great way to kind of get up-to-date information, and faster than our typical newsletter cycle of things that we're doing and seeing, and you'll learn all about the different things that we're doing too with these webinars. We'll also be putting out when these things go on YouTube. We'll have different YouTube videos and things that a lot of them are derived right from these seminars that we're doing. We'll have other documents too that we're going to be having coming up lately. When it comes to practice aids, things like that, and when it comes to implementing new standards, we're going to have those up there as well for you. So it's a lot easier for you to go back and start to implement these. But I would encourage too people to call me if you have questions, if your boards have questions, which many of you are, while no one's answering, asking any questions right now. When there goes time to actually implement these, you're probably going to have specific questions when it comes to your own organization. Feel free to call us, feel free to email us and ask us stuff. Don't feel like you have to be going through this alone, and that's why we're here. Does anybody else have any questions before we wrap this up today? Like I said, we finished a lot quicker than I thought because we haven't had any questions. But if you don't have any questions, thank you for joining us today. I really appreciate it. We're going to be sending a survey out as well to let us know what you thought of everything. Feel free to answer that as well. And thank you again. I look forward to talking with everybody soon.